September 25th, 2024. Today we had a wedge open. One, two, three. Going back to yesterday, we actually had no gap today, which is pretty rare. But we had a wedge open and then a tight bear channel for the remainder of the day, which basically turned into a trading range. It's pretty unusual for there to be no gap, but most of the patterns today are pretty basic. But I think it's really difficult to get in on these sort of shorts. So at a certain point, you kind of just have to hold your breath, or and just get into the market, sell for any reason, sell below any bear bar, and just get out above a good looking bull bar. And you can sell. And if you had done that at any given point, there's really no reason to get out until 53, 30, 32 maybe, but you probably have to sell again 38. So I think at a certain point you just got to get short. Bar one, a bull bar, but a big tail on the top. We're breaking back above the all-time high. So it was important. The all-time high was right about here, and we went one tick above it on bar one. So the all-time high coming into the day was right here. Possible that we're starting some sort of bull trend, but not really all that likely. I think the bulls need to do more. We need to get consecutive bull bars closing on their highs in order to convince me this is the start of a bull trend. Right now, it just looks like a leg in a trading range. When you're in a trading range, previous lower, or when you're in a bull leg in a trading range, when you start to come back down, the higher lows are support. So you knew that this area was going to be support. You know that this area is going to be support. You can see on 3, we tested down to that bar 80 low. And on bar 17, we tested down to the open of bar 78. So you knew those areas were most likely going to be support. Bar 2, an inside bar, a bear bar, but a big tail on the bottom. So not really worth shorting. It's a possible high of the day. However, usually if you're going to get an early high of the day, you're going to get a better signal bar than we got on bar 2. So you'd be expecting, if we were going to get an early high, 2 would have closed on its low. So it's a low 2 short for the bears. The low 1 short was below bar 79. And this is the low 2 short below bar 2. But it's not really worth taking unless you're using a wide stop and willing to scale in. I'd probably just rather wait for strong follow through. 78 and bars 81 and 1 were all reasonably big and strong bars. 81 was not very big, but it was a strong close. And then this is a pretty big bar. This is a big bar that closes reasonably strong. So I want something really good from the bears in order to short. I'm not really willing to sell below a bear bar that has a big tail on it. Bar 3, big tail on the bottom. So a lot of the bears who did sell below it ended up just basically scalping out around the bar 81 low. Probably a better bar for the bulls than it is for the bears because it reversed up so much. So probably sellers not too far above, but a big reversal up. Probably buyers, somewhere down here if we get back into this area because we have support and we have support again. So I'd imagine if we get back down here, there'll be buyers like there was during 5. 4, another bear bar, but again, problem, there's tails on the bottom. It's an inside bar, so it's a low 1 short for the bears. So the bears are hoping, they can, this is the start of a bear trend, right? They're thinking that bar 2 is the high of the day. Bar 4 is obviously a low 1 short, but they're hoping that we get a strong breakup below down to at least here. I'm not really all that convinced that we're going to get that. It seems, sorry, I was checking something. Seems more like these bars are all getting tails, and this is looking more like a leg in a trading range, the same way that this was a leg in a trading range. So I do think that we're going to get one more leg sideways to up. 5, a bull bar, but a big tail on the top, so really not as good. You can see we went down to moving average back into this area and found support. You could argue it's a head and shoulders bottom, 83 and 5, but it's really not a great looking pattern. And after 3 straight bear bars, there's probably going to be sellers somewhere above here. So if you're buying above 5, it's kind of bad math because there's no, it's a double bottom 3, 5. You could argue 40% chance measure move up, but what's your risk reward? You're risking 5 or 6 points trying to make 8 or 9 points, and you only have 40% chance of success. So it's really not very good. So that's why most traders will not buy above 5. They'll wait for either the probability to get better or they'll wait for a deeper pullback. So why did we go up after buying above 5? Well, some traders, if they're buying it, they're not buying it with a stop below 3 and going for the measured move because the math isn't very good. They're probably buying it with a stop below 78, or maybe even below 59, and they're willing to, 61 yesterday, and they're willing to scale in lower. So, it's not really a great stop order trade to buy and put your stop below 3, but if you use a wide stop and you're willing to scale in, we'll probably come back to this price later in the day. 6, a bull bar, but a tail on the bottom, a tail on the top. Again, we're not really able to get strong closes. So traders not really as interested as at buying these highs. They're more interested in buying pullbacks. You can see traders more interested in buying around a 50% pullback of bar 5 because the math gets better. If you're willing to buy a 50% pullback, your risk reward gets a lot better. And if you can get a bull bar closing near its high, like we kind of did on 6, it increases the chances for the bulls that we're going to get some sort of move up. 7, another bull bar, but again, tail on the top, tail on the bottom. What does this look like it's forming to you? Probably a wedge. 78, 1, and then, you don't know at the time. It ends up being bar 8, but whatever, 7, 8, 9. There's going to be something over here that's going to form some sort of wedge. So 8, a bull bar, trades to a new high, and we find sellers at the new high. A lot of the bears, any bear who's selling below here, either they scalp out quick or they're willing to sell more at the new high, betting against a bull trend day. So the bears, they don't want to have a stop above here because they know there's more sellers up here than buyers because it's a third leg up. So if they sell, they're going to scale in higher up here and look to exit on a leg back down. Probably some buyers below 8. However, it's a third leg up. So buying below 8 really isn't as great as it could be because of the wedge. So buyers below 8 initially during 9. Bulls are hoping that 9 is another high one in their bull trend, and that we're going to get a breakout above the wedge and a measured move up. But if we're going to get a breakout above the wedge, we're going to need to start to see really good looking bull bars, and we're going to need them really quickly. And it doesn't really look like we're getting that. It looks like we're getting more sideways price action. 10, a bear bar closing near its low. It's a wedge. It's a credible sell for a possible high of the day. Probably okay to just put a stop above 8. If we break out above the wedge, it's relatively 50-50 that the breakout's going to succeed or fail. So probably okay to just exit there and look to sell another reversal down if you get it. 11, a bear bar, but a big tail on the bottom, right? So a lot of the bears who sold below 11, they scalped out with 4 points because the daily range is smaller. So you can see, a lot of the bears who sold below 10 were able to scalp out with 4 points during 11. Basically, just, some of them would take a chance at the high of the day, but they made quick 4 points with zero true risk. So it's reasonable for them to scalp out. And so a lot of them do during bar 11. Bar 12, a bear bar, but another big tail. So bears down here were able to make 5 points. So what's the problem, right? For the bears, well, we're getting huge tails. So 11, giant tail. Bears more interested in scalping out down here than they are interested in selling more. Again, tail, bears scalping out. So possible wedge, 9, 11, 12. So we're probably going to get at least a minor reversal up. Well, if we do get a minor reversal up, you probably just keep your stop above bar 8 if you shorted and just hold, taking a chance that we've seen the low of the day. It's not really worth exiting and trying to re-enter. 13, a bull bar, but a big tail on the top, and you're buying a flat moving average. And yes, it's a double bottom, 3, 13, but you're buying a flat moving average after 4 straight bear bars, and the bar has a tail. So the risk reward isn't good. You're also buying, it looks like you're buying low in the trading range. I get why you might think that, but you're actually probably buying a little bit closer to the middle. Well, I suppose you're buying a tick above the lower third, but still not really that great of math because of 4 straight bear bars and a weak signal bar on the moving average. 14 consecutive bull bars, but 14 is not the follow through you want if you bought above 13. You probably wanted to see a better looking bar. 12 is a sell climax. So if we do start to rally, the bar 12 high or the bar 12 open ends up being a magnet, probably sellers up in that area. You can see there were probably buyers below 14 initially, but it's not really all that great. Also, the daily range is something to keep in mind. The daily range is currently 10 points. It's not going to be a 10-point day. And if it is, then you shouldn't be trying to chase breakouts. So it's really, really unusual to get a day this small. I don't even remember the last time I saw a day that small. It's been years. So it's really not worth trying to, front run breakouts. It's probably okay to either just sell the market, throw a stop above 8, and take a chance that the market doubles to the downside. But I probably would not be buying here because the context is not all that bullish. We're pretty overbought on the daily chart. So it's really not worth taking a chance that we rally. So 15, buyers below 14 initially. You can see the bulls who bought below 15. So bears, they see a low one short on 14 and they want at least a second leg down. And 15, you can see not really great, the low one below 14, but some bulls buying below, and they're going to basically sell out of their longs. If they took it, they know it's a quick scalp. They're probably going to sell out of their longs right back around the bar 14 close. So the bears, the bulls, they buy below and they scalp out up here during 16, and that's probably a big piece of what's causing 16. Could be two legs down, one pullback, two, and it is trading range price action. So if it is two legs down, you might get one or two legs sideways to up. However, it's not really worth exiting your longs. Sorry, exiting your shorts. You know you're expecting a minor reversal. 17, an outside up bar. Not really great math for the bulls to buy, and it's not really great to exit because there's probably sellers somewhere up here. So it's really not that great for anybody. The risk reward is bad for the bulls and doesn't close on its high. It closes below the moving average. Probability isn't all that great either. Bar 18, an inside bar, so an IOI pattern. So 16 is inside of 17 and 18 is inside of 17. So it's a breakout mode pattern. General, when you get a breakout mode pattern, 50-50 chance the first breakout is going to fail and you get a reversal. Again, the same way that the bar 80 low is support during bar 3 and the bar 78 low is support during bar 17, the bar 15 high is going to be resistance if we rally up to it, 18, 19, 20. Why is it going to be resistance? Because it's a lower high. So when you get lower highs in trading ranges, you're expecting resistance. And when you get higher lows in trading ranges, you're expecting them to be support. So 18, an IOI pattern, theoretically it's a buy above 18, but the same problem I have with 17. Your risk is really large and your reward is probably not all that good. 19, a bull bar, but basically just a doji, big tail on the top, tail on the bottom. Probably buyers not too far below if we go below, and probably sellers not too far above if we go above. It's not really worth doing anything. 20, a bull bar. It's an inside bar, another IOI pattern, another breakout mode pattern. Probably sellers not too far above, but also probably buyers below, because after 4 straight bull bars, you have to be expecting that bulls are going to step in and buy below, especially considering this is probably some sort of trading range. 21, bear bar, but not really all that great to be selling here. I think there's probably going to be buyers somewhere in this area. You know that the bar 17 low, bulls are going to buy around the bar 17 low. So probably traders buying, and maybe they'll buy below 20 directly. Maybe they'll buy below 18, thinking that 17 is a spike, and this is a bull channel, and they'll buy below there. Maybe they'll buy around the close of bar 17, taking a chance that this is going to be support. We're going to bounce for at least something. We should get back to the bar 20 low, because the bulls who buy below 20 and are willing to scale in will probably end up making money. 22, a bull bar, but a big tail on the top, so not really that great. The bulls maybe argue higher low major trend reversal here, but your bear trend is only 7 bars, so it's really not a very good pattern. If you're buying above 22, you're buying probably more towards the middle of the trading range than the lower third, and you're buying a flat moving average, and there's a tail on 22. So nothing is really all that great right now. Your risk is too big. Your reward isn't good enough. 23, a bear bar closing near its low. Bears selling this. They want some sort of breakout below the possible wedge. So maybe 1, 3, 17 is a wedge. Micro wedge, 11, 13, and 17, things like that. But probably going to be buyers below if we do get there. So 23, a possible sell at the moving average, but not really worth it. 24, consecutive bear bars closing relatively near their lows, but you'd have to imagine that there's buyers below. There's a tail on the top of 24, meaning that overlap with 23. And if you sold below 23, what did you want to see out of 24? You also have to consider that 24 is good enough follow through, but you wanted to see a breakout below the bar 22 low, or a breakout below the bar 17 low, or something like that. So 24 buys you some time if you shorted, but it's not really the follow through bar. You still need more follow through before you get a pullback if you're thinking this trade is going to work. And then you get a doji bar 25, and I think 25 is pretty disappointing for the bears. So what do? They sold below 23. They're disappointed with 24. They were hoping it was going to be stronger, and then they see 25, a doji bar. Some of them, I'd imagine, got at least 1-to-1 of their true risk. So the low of bar basically 25 is around 2-to-1 of true risk for the bears who sold below 23. So a lot of them will scalp out, and the ones who don't are disappointed with 25, and they buy back their shorts at the market, and that's what causes 26 to be a bull bar. However, 26 is bears buying back shorts. It's probably not as much bulls buying, and you know that the bar 22 high is going to be resistance. So big tail on 26, not really all that great. The market usually tries to break out around bar 30 if it's in a trading range for the open of the day. 27, a bear bar, probably initially buyers below 26, but we're slowly channeling down. It is a bear channel. You have to keep that in mind. We have a lower high, 8, 20, or 8, 19, 27. We have lower lows. 83, 17, things like that. So you have to keep that in mind that we're slowly channeling lower, and we probably went always in short, I would say, on bar 12, and I don't think we've really flipped back to always in long since that time. So 27, a bear bar, buyers below 26 initially. 28, a doji bar, probably sellers above, willing to scale in higher. Not really all that great. Not be doing much here. 29, another bear bar. So 3 straight bear closes, 27, 28, 29. But look at the tails, right? It's really not all that great. 29 does break out below the low and closes below it. So that is a confirmed breakout on 29. However, it's not necessarily a strong breakout. Just because it's a breakout doesn't mean it's very strong. And I'm not all that convinced that it's strong because of the tail on 27, the tails on 28, and the tails on 29. 28 is a doji bar, a pause bar, which pause bars are normally fine, but they usually lead to a pullback before trend resumption. And I don't really think that this is, a very strong trend. So it's not as great to be selling these closes. 30, a bull bar, but tail on the top, and it trades above 29. Had 30 been a smaller bar and an inside bar, it would have been a more credible buy, but it got too large. The risk got too large, and traders don't want to trade with large risk in trading ranges. They want to trade with small risk. So disappointing on 30. Again, still a bear channel. 31, an inside bar, a doji bar, probably buyers not too far below, probably buyers below 30 if we get there. It's another IOI pattern, 29, 30, 31. 32, a bull bar. It's a doji bar, probably sellers not too far above. It's, you could argue it's a good looking reversal, some sort of wedge, but wedges form constantly in trading or in bear channels, and they always end up failing. Bear channels and bear trends constantly form wedges, but they end up being meaningless wedges. And B, if you're buying above 32, it's realistically just a doji bar, and you're buying expecting a reasonably good swing up. But you look at your risk reward. If you're buying, what's 2 to 1 of your risk reward buying above 32? It's way up here. Do you really think we're going all the way up here? Probably not. So it's kind of hard to buy above 32 and create a tradable equation with it. Some traders will use a wide stop and try to scale in, but a lot of those traders are going to exit in this area, most likely. 33, disappointing follow through. Probably relatively expected if you took the buy above 32. You're probably not going to get immediate follow through. We're probably going to pull back because of the risk reward. Traders are more willing to buy a pullback than they are to buy directly above the bar. Bears see 33 as a low one short, probably initially at least buyers below. 34, another bear bar, but probably buyers below, scaling it lower. A bull bar, 35, it's a high one for the bulls, so they're hoping it's a breakout pullback. 32, but again, probably sellers not too far above. We need to get above the moving average, and the bulls need to show me that they can hold above the moving average in order for me to look to buy. 36 is disappointing follow through because the bulls who bought the close or who bought above 32 scaled in 33, 34, and you can see they used 36 to exit their longs. They did not buy more and cause 36 to be a big bull bar closing near its high. They instead exited their longs on 36, and that's what caused the big tail on 36. A lot of other bulls seeing that will exit their longs, and that causes 37, but probably initially at least buyers below 32. So we're not going that far down on 37. Big tail. Bulls are hoping double bottom 37, 32, but I think if we were going to rally, we would have already done it. This isn't all that great. An inside bar, a low one short for the Bears, 38, and it's a possible wedge pullback, 30, 32, and then 35, 36 is 3 pushes, or you could just argue 30, 32, and 37 low is a wedge. So the Bulls were trying to get a reversal, but it ends up turning into basically just a sideways to down wedge. I refer to this more as a 3-push pullback, but a sideways to down pullback, and so we might end up breaking out to the downside here. You can see the market ended up getting a little bit steeper. 39, another bear bar. Follow through for the low one short, tail on the top, tail on the bottom. So a reminder that we're still in a trading range, but it does close at the 37 low, which is good for the Bears. It would have been better had it closed below the low, but they're closing at the low still increases the chances that we get a breakout to the downside. 40, another big bear bar, good for the Bears, or not a big bear bar, but another bear bar, good for the Bears. We have 4 straight bear closes, so the first reversal up will probably be minor, probably sellers not too far above 38. What's the target? Well, obviously the 61 low is a possible target. And you can see on 41, as we rally, traders sell above 38 and scale in higher, taking a chance. We're not going to go above the most recent higher low or lower high, which would be bar 36. And why? Because we haven't all day. We haven't broken the most recent lower high all day. We just keep getting lower highs. So why would it be different this time? And if it is, the bulls need to prove something. Markets are resistant to change, and right now the inertia is with the bears. And 37, 38, or 38, 39, 40 is climactic, sure, but increased chance that we get something to the downside. 41, a bull bar, like I said, but sellers above 30, 40. 42, a big bear bar. So 41, possibly trapping out weak stops. Traders who had stops above 38 or only a couple points above 38. 41 traps them out. And then 42, a bear bar closing reasonably near its low, but a tail on the bottom, and it doesn't close below the bar 40 low. 43, you can see we basically got a collapse in the beginning of the bar because bulls gave up, and that's what's causing this. But bears just wanted to basically get to the bar 60, 61 low from yesterday. Assume, there's some other reason. Yeah, so this breakout point. So right here, the bar 9 high, the traders who sold above the bar 9 high should have made money. And if they sold and they were willing to scale, you can see that they got trapped. But if they sold and they were patient and they scaled in all the way up, they were able to get out during bar 43 today without a loss and a profit on their later entries. So you can see the bears scaling in and making money. Sellers above 43 most likely, but tough with such a large reversal. But sellers above during 43. During 44, a bear doji bar, a bull doji bar, a low one short. Not really worth selling though. Probably buyers below scaling and lower. But we should get below the 43 low just on the basis that if you bought above 43, you're probably going to get stopped out because that's not a very good trade. Big bar, big risk, low probability. 45, buyers below 44, but not really a good buy. Bulls, hoping that 43 was the start of a rally, or the big reversal up was the start of a rally. And 45 is their breakout pullback, but it's a bear bar, so it's really not very good. Bad high one, probably sellers above during 46. 46, like I said, sellers above. 47, an inside bar, a low one short, but I don't want to sell. This might be forming a final flag. It's okay to be holding short, probably stop above, I would say 44. If you'll notice, 41 should not have happened if this is going to be a big bear trend. So this was the start of the trading range. But sometimes when you get the start of a trading range, the market continues down and then just comes back to the start of the trading range. 42 sell climax high, which we came up to here. 48, another bear bar. So follow through for the bears who sold below 47, but it's basically still your entry price. And then 49, a big bear bar closing near its low. Some traders will sell, but it's probably for a scalp. There's probably buyers at the 43 low. This has gotten more parabolic. If you look, the move down to bar basically 30 or like 37 wasn't all that steep, and it's gotten steeper from 37 to this area, 43 or eventually 50. So to me, it looks like some sort of maybe consecutive wedges when it gets steeper like that. Probably buyers in this area. 50, a big reversal up, but giant tail on the top, giant tail on the bottom. Not really worth buying, but we're going to get a second leg sideways to up, and there will be buyers below. 51, an inside bar. Low one short, but a big tail on the bottom. I think 50 is pretty damning evidence that we're probably all done with the big bear trend, but still okay to be holding short if you're always in short. 52, a bear bar, but the context is calling for us to probably stop going down and start to go sideways. We have big reversals and a micro double bottom. 50, 52, so it's a second entry buy in theory, but the first entry didn't trigger. So probably if you sell above 52, you're going to be able to scale in and make money since it's a micro channel of 6-7 bar micro channel. So probably if you sell above it, you'll be able to scale in and make money. But the question becomes, you're probably going to get a bounce. So are you willing to sell here and scale in all the way at the sell climax high, and then ride it back down and then exit here? It's pretty hard to do. So 50, if you sold above 52, you see 53, you're probably not really very thrilled, and a lot of traders would panic out when they saw that. 53, a big bull bar closing near its high, probably sellers not too far above, but it's big enough for a second leg sideways to up. However, it's going to be a minor reversal because we've just had a 40 plus bar bear micro channel. So it's not like we're going to get a giant reversal up on the first go. So you can expect this to be a minor reversal. 54 consecutive bull bars, good for the bulls, but probably just testing back to the sell climax high. Bulls who buy above 53 might start scalping out. Exactly what happens on 55. You know that we're probably going to get a higher low from the massive rally from 53 and 54. But you also know the bears who sold the 52 high and are willing to scale in are going to make money. But you also know that the bears who sold 52 high and were willing to scale in are not very thrilled with how their trade is going. So they're going to buy back their shorts. And so limit order trade reasonable to buy the 52 high. 56, another bear bar, but tail on the top, tail on the bottom. Not as good as it could be. 57, 3 straight bear closes. So bear bar, or 3 consecutive bear bars. But it's a trading range, right? It's a leg in a trading range. 53 and 54 are really strong. I don't think we're going to go, we might go towards the low, but if you're long, it doesn't really make sense to exit here because there's going to be more buyers below there than sellers. 58, a bull bar, but a tail on the top. So not really worth the buy. It's a double bottom, 52, 58. In theory, bulls want a measured move up from the neckline, but it's not really going to happen. It's probably still a minor reversal after 3 straight bear bars. 59 consecutive bull bars, but big, tail on 58 and 59, not really all that great. 60, 3 straight bull bars, good for the bulls, but we're testing back up to the bar 54 close. If you bought the 54 close and scaled in, how do you think you feel about your buy at the 54 close? Not great. So there should be sellers here, and we can't even get above the bar 60 high. And see, we trade back down. Some bulls buy on the limit order at the 59 high during 61, taking a chance we're not going to collapse straight down. And if we try to, there'll be buyers below 60. So this is a trading range. So big bar, big risk. 60 in a trading range, not great. 61 high one for the bulls, but high in a trading range. So really a better sell above than a buy above, but not really great to be selling after 3 consecutive bull bars. You can see 62 touches to 54 close and then sells off into a doji bar. 63 buyers below. It's bad low one short for the bears. Sellers above. 63 though. You could argue high 2 for the bulls, but not really want to buy above bear bar, high in a trading range. 64 sellers above. 63. 65, you can see a doji bar, but this is just starting to go sideways, so I'd probably just look to be done. 66, you can see buyers below, and then probably sellers above 66, but I don't think any of this is all that great. We are holding above the moving average, which is good for the bulls, and we've gotten a lot of reasonably good-looking reversals up, but I don't think any of this is all that amazing. I think we closed around the midpoint. Yeah, so that's not surprising. On trading range days, the market often tests the midpoint, and you can see we basically went sideways around the midpoint. Oops. 68, a bear bar, closing somewhat near its low, but around the moving average, and 69 consecutive bear bars. Probably, maybe back to always in short. You can sell below 69 for a second leg sideways to down. 70, 3 straight bear bars, so probably sellers above. You can expect a second leg sideways to down. But initially, buyers below 70, around the bar 66 low, because 66 is a higher low. Probably some support during 70 or during 71. Probably sellers above 71, bad high 1, and then 72. We got a third leg down to bar 75. It's a wedge, 63, 66. 75 or 61, 66, 75. And then we basically got a rally into the close. So it's small, but it's a buy the close finish. For stop orders today, pretty tough. You could sell below 10. If you can hold through all the noise, you would have had a pretty good trade. You could theoretically, I wouldn't sell 23. It's kind of tough. You could sell 38, maybe 39, maybe 42 or 48. But tough. You could buy 53, but you need to know what you're doing. You need to be able to manage that trade because it's probably, not going to race straight up. So it's probably going to go pretty far against you. And, you know that the 52 high is going to be a magnet. And then you could buy above 75 or you could sell below 69. Limit orders was probably easier thing to do today. You could sell above bear bars, taking a chance. As swing trades, you could sell above 38. That's probably a reasonable thing to do. You could probably, I think probably you could buy below 20, but I think the context of the day was a little more bearish, so it's not as great as it could be. But probably a reasonable scalp. And you could sell above 52, but the context is not very good, so I wouldn't. Better, you could buy the 52 high on the test back down during 57. And yeah, those seem like the easier ones. So trading range, bear trend day, but ends with the trading range. Wedge open, tight bear channel, trading range, close around the midpoint. You can see we've basically gotten 5 straight doji bars. So what does this mean? It's probably a final flag. So when you're getting this many doji bars, it usually ends up looking like a final flag. So if we break out above, however far we break out, we're probably going to reverse back in this area. The weekly chart, bulls trying to break far above last week's high. We did trigger above last week's high, but they're trying to get a strong bull bar closing far above last week's high. They're not doing a very good job so far. And the monthly chart, the month is almost up as long as the bulls are totally content. The monthly chart bulls are totally content with, getting doji bars until the end of the month if we keep it above the July high. So they don't want this to sell off. And the bears are trying to get the market closed below the July high. So that will essentially be what the fight is about. I'm probably going to add I call this one Al's folders because I just go on his encyclopedia every day, or most days. I've been bad about it recently, but I just go on his encyclopedia whenever he posts the slides every day. So I just create my own that have to do with his and track those as well. But feel free to, use these slides or, basically take them and start your own encyclopedia. It's a good way to study. All right, that's going to be it.